Andrew Holland, CEO at Avendus Capital, All Strategies, joins us. Hi, Andrew. Good morning to you, and thanks a lot for joining us today. 8% rally already. 8% rally already seen in last two sessions, and this can be attributed to the EPS upgrades which have come by. Have you factored that, or are there more legs to this rally?
No, I think there's more legs. I mean, if let's just go back. When Prime Minister Modi won that mandate, if you would have had these kind of tax cuts then, the market would be a lot higher than it is today. So I think we'll hit new highs on or before the monetary policy in a couple of weeks. So I think the momentum's there. I think this was a big game changer for all of us. So we're not near the highs yet, but I think we'll quickly probably get there. So I look at it slightly differently. Yes, there's been an upgrade in earnings, but now the momentum is there. And of course, there's lots of more positive news and everyone's hoping for in terms of personal tax and then capital gains tax going away. So any of these factors come in as well would be the extra fillip you need. But I think between now and the monetary policy, I think the market will try and hit those highs.
We'll wait out for those highs of 12,100, which was seen early this year. Andrew, no change with regard to personal taxes and the capital gains that you highlighted. But for the FIs, they've rolled back first the surcharge and then again surcharge on capital gains on sale of securities and also on derivatives. How big a move is that, considering after a while yesterday we did see big buying figure coming in from FIs?
Yeah, I think that was done some time back. I think that was just a clarification of what they'd done. I wish to do the same for Category 3 in terms of derivatives tax, but that aside, so I think FIIs, obviously were probably kind of majorly short the market, and now in kind of a more kind of uncertain kind of global economy, India continues to stand out. So there'll be more flows. We saw some significant flows yesterday. I suspect that India's back on their radar. What was from last Friday, and now they'll be looking to put more money to work in India compared to other global emerging markets where there's still that problem of the trade war with China, and obviously a slowing economies. We saw the German figures yesterday, which were very bad. So India stands out from being defensive, has now its own momentum. So expect more flows from foreign investors.
Yeah, Andrew, would you tweak around with your end of year index targets if you do have one in mind?
So we usually don't think about index targets. We're an absolute return fund, so we're just trying to make our returns for the year. But usually we go in line with earnings. So let's say that this year is a bit of a washout for earnings, and obviously we fast forward to next year. So the kind of earnings we'd be expecting for 2021 would be in the range of 10 to 15% at this point, because you still have to see some of this play through, obviously, into final demand, which we think will start to happen probably in the next quarter. But that would kind of lead me to think that the index could move up in line with with index earnings of around 10 to 15% from here.
So would you say that this would probably take some time down the line while the initial kicker has come in the form of additional cash on the books to make sure the demand kickstart? And the fact that we've got a deadline of March 2023 for new manufacturing units to kickstart production, all of that in a way, extends this process a little bit more, because you now start making those capex investments, and then once they fructify, that's the time that you'll actually see a meaningful push to growth on ground.
Yeah, no, I mean, prior to this, our hopes were that, when Prime Minister Modi came in, that they'd help the economy, kickstart the economy in some way, which we now know what they're trying to do. And the hope was always that, you know, the capex cycle would start to pick up in the second half of the year. That's obviously been delayed by a quarter or maybe more, but that was always the expectation, and that's the kind of multiplier effect that you need. And a lot of industries are running at you know, 75% plus in terms of capacity utilization, so there will have to be investment. But I think the other thing that comes out of this is that you kill the, you know, many birds with one stone, in terms of that you can now attract foreign direct investment, you know, in the Make in India kind of mode, you know, for what Prime Minister Modi wants to do. So I think that augurs well. I mean, obviously there's other things that you have to do in terms of, you know, opening, you know, bringing that red carpet out and making sure there's land available, maybe some labour law kind of changes. So all of these things will be secondary, but, you know, I think the gates have been opened, and I think foreign direct investors will now look at, you know, setting up alternative manufacturing plants in India, given the tax rate, and it's favourable against a lot of the Asian markets as well, so, or Asian countries, should I say. So that's, you know, that's, I think, the extra part. But anyway, India Inc. probably needed to invest. So what I think it does in the short term is that the kind of fear of job losses and companies, you know, not expanding, you know, now changes that view. And, you know, I think as we start to see that the positive you know, nature of Indian entrepreneurs will start to come to the fore, and that will help as well. So I think there's quite a few things the government still needs to do, but if they continue to do what they've been doing, then I think we're all going to be very happy.
You know, the stimulus will probably push the fiscal deficit closer to 4% from the earlier 3.4% that the government was factoring in. In light of that, you know, conversations with foreign investors suggest that, you know, they're still not worried with regards to whether or not there is a big a fiscal miss on that count, unless and until, you know, the government takes measures to probably go ahead with the you know, sovereign bond program and issue bonds into the global markets. Do you feel that's an approach that the government should really think about?
So it's one approach they could do. I mean, I agree. I don't think we should worry too much on the fiscal deficit widening. You know, it's not as though we're alone with fiscal deficits in the world. You know, we're the only ones who are trying to reduce it seems. You know, my view would be, if you get the economy moving, you know, then earnings will start to rise, and then you should look at the divestments or privatization program. You know, that could be a big windfall for the government if they go and sell down on companies directly. I think the ETF kind of has not really worked in terms of helping that divestment. It's just led to lower share prices for most of those companies. So I think divestment program, that will help shore up your kind of deficit going forward. And who knows, once you get onto that road, then there's many more companies I'm sure would be looked at. And you know, if you go back to, I think was it Aaron Shurry when he first started that, you just need a leader to do this, you know, someone campaigning to get the divestments done, and I think there'll be a lot of takers. So I think that's the way I would go. Bonds you can do, I think that would help, but I think the divestment program would have more, to my mind, an impact, a positive impact on the markets generally.
Okay, got that. Andrew, it was great chatting with you. Thank you very much for joining us this morning with your thoughts.